Over the next 4 to 8 years, the monetary expansion rate is going to be double what it had been in the past 10 years. The nominal yield is going to be zero. The real yield is going to be minus 15, minus 20%. If you want to be rich or stay rich or maintain shareholder value, you got to hit that hurdle rate. That's traditionally been 10% a year up until 2020, and then it doubled.
Welcome to Dream Richer. The year 2022 has seen the investing world full of mixed feelings. From feeling bullish on certain coins at the start of the year, and now feeling bearish all of a sudden, given the recent Terra USD crash. Many are left wondering what the future holds. The billionaire investor Michael Saylor, however, never seems to shy away from answering these difficult questions. Today, the multi-billionaire exposes everything he sees coming over the next 4 years. In his words, the monetary expansion rate will be double what it had been over the past 4 years. The monetary policy is the bedrock of any nation's economic policy. And everyone, from part-time workers to huge financial institutions, both foreign and domestic, are impacted as it shifts. Hence, with the banks increasing the supply of money, there's more side effects than just the ones that meet the eye. For example, when the US banking system collapsed, leading to the Great Recession of 2007 and 2008, the Federal Reserve cut interest rates to near zero to jumpstart the US economy, thus expanding economic growth. It recently did the same thing to pull the country out of the 2020 COVID-19 recession. By the end of today's video, I will also show you the exact economic monetary expansion rate of the USA and all its possible side effects. If you find the video helpful, then don't forget to subscribe. Let's get right into it.
Quarter of 2020, interest rates have been sliding for a decade. You know, hope springs eternal. And I pretty much lost hope. They got pegged to zero. You know, Jerome Powell said we're not even thinking about raising interest rates to the year 2024. I said my $500 million looks like dead money. It's going to generate zero. The company started generating much more cash. We thought $75, $80, $90 million a year in cash flow on the operating side. But then we saw on the balance sheet side the cash was going to generate zero. And then we watched as there was a K-shaped recovery and assets all appreciated in price 25%. And I started thinking, over the next 4 to 8 years, the monetary expansion rate is going to be double what it had been in the past 10 years. It's going to be going from 10% to 20%. This treasury balance is going to lose 20% of its purchasing power a year. The nominal yield is going to be zero. The real yield is going to be minus 15, minus 20%. My investors valued the company at 1 times revenue plus the cash. Their view was cash is trash, give it all back to us. And so we got to this point where I realized we either needed to give all the cash back to the shareholders and decapitalize the company, or we needed to invest it in something which was going to go up in value more than the rate of the money expansion. And that set us on this search for what eventually became. I think there's 2 types of inflation you can focus on. One is consumer inflation as measured by CPI, and the other is asset inflation as measured by, and I think the best surrogate I can find is the S&P index. So asset inflation is the cost of capital. It's the cost to stay wealthy. If you want to be rich or stay rich or maintain shareholder value, you got to hit that hurdle rate. That's traditionally been 10% a year up until 2020, and then it doubled. You know, so and it almost went to 25%. So the monetary inflation rate is the cost of capital, is the S&P index. If you're a private individual and you own everything you need, your car, your house, and you're looking toward retirement, you could think, well, I just need to keep up with the CPI. I don't need to buy anything. I don't need to buy stocks. I don't need to buy a house in the Hamptons. So if I can keep up with CPI, I'm good. But if you're a young individual, you're in your 20s, you want to buy a house, you want to send your kids to expensive school, you want luxury assets, you want a stock portfolio, you want Social Security from the private sector, If the price of an S&P stock is going up at 10% a year and your salary is going up at 3% a year, you got a negative real yield of -7. I need to beat the S&P index. How do you do that? Well, you could buy the S&P, but the problem is not very popular with your shareholders. And there's a technicality, which is the S&P index is a security, and you can't hold more than 40% of your assets as securities if you're an SEC operating company. You know, the general idea, the theme is you're sitting on conventional treasury strategy, which yields 1% interest. And the monetary inflation rate, the cost of capital is 20%. You're minus 19% real yield. You're burning 19% of your treasury a year. It used to be sovereign debt yielded 5%, 4%, 6%, and you expected 7, 8, 9% inflation. You're a minus real yield, -3. You can do that for 30 years. And if it's going to take 30 years to burn your treasury, you can justify having a conventional strategy because you're better off to have the insurance policy for 30 years just in case to protect the operating business. But when the cost of capital goes to 25% and the nominal yield is 0 and your negative real yield is minus 25%, now you're burning through your treasury in 3 to 4 years. Now that's not the worst case. The worst case is I'm sitting in Argentina or Turkey or Lebanon or Venezuela, and the inflation rate goes to 100% or 200% or 1,000%, and you're going to burn through all your cash in 12 months. Then we're a low-growth company generating cash that's losing 15% of its purchasing power a year, competing against Microsoft. And at that point, well, your shareholders start to wonder whether you'll be around, so the stock trades down. And then the employees start to wonder, and then the customers start to wonder. You get yourself in a death spiral, and you can spin into oblivion.
Recently, Jerome Powell, the chairman of the Federal Reserve, convened a 2-day meeting in Washington, D.C. with the 7 other central bank governors to officially end the policies that had kept the economy propped up during the pandemic. At the end of the meeting, the Fed did what had been expected to do and raised interest rates by 1/4 percentage point. A clear strategy to slow the economy and presumably tamp down on the highest inflation rate in 40 years. What wasn't known, however, was how the Feds were planning to go even further to slow borrowing and spending. The central bank announced it would start selling off the $5 trillion in debt it had bought up during the pandemic at a rate of about $1.1 trillion a year, possibly more. This is a move that is very little understood by economists, but could happen as soon as next month. This could also raise the odds that the economy tilts into a recession.
Why I concluded in essence, the traditional treasury strategy is bankrupt, in a highly inflationary environment, and you got to do something different on your balance sheet. I want to replace my balance sheet with some property, a non-currency derivative. So I either buy a building, or I buy land, or I buy a portfolio of art, or I buy gold, or I buy some crypto gold, right? And after sifting through every possible property, I settled upon the idea of crypto gold, and then I sifted through 6,500 cryptos, and I figured Bitcoin is the closest thing to digital gold on the dominant network. It's the least risky of the crypto assets, and it's the one that is acknowledged as a property. But I don't think anybody reasonably can expect that we're going to go back to a tighter money policy than we had in 2019 or 2018. So my forecast there is all the strong currencies of the world, which are the dollar, the euro, and then all the currencies pegged to the dollar, the DRAM, etc. All of those currencies lose 15% of their purchasing power a year for quite a while.
It's clear from Michael Saylor's explanation that any currency derivative is perhaps no longer a viable investment solution. In the past, where the banks would pay you interests of up to 7 or even 20% to keep your money locked up, you now rarely get any interest over 1% from the bank. Why? Because of excessive money printing and an ever-increasing money supply, which Michael Saylor argues will cause USA monetary supply to double. The US money supply has grown 20%, from $15 trillion at the end of 2019 to $18.3 trillion at the end of July. It forced many to be unemployed and become dependent on the stimulus checks sent out by the government. Do you believe the Feds will achieve their goal of lowering inflation or only cause more of it? To learn more about the latest crypto news, watch these videos here.